This is a 25 marker from paper 3. It deals with investment in the Chilean economy. We're going to be looking at the micro and macroeconomic impacts. We're going to look at labor productivity. We're going to look at variable costs for businesses. We're going to be looking at aggregate demand and inflation. I suggest, as always, that you have a quick look at the beginning of this essay and then try and write up your own and let me know whether what you come up with is similar to what I've written, because it'll give you kind of a benchmark for whether you're coming up with the right ideas or whether you feel like, it's not really fitting with what you're writing. Maybe that suggests you should rethink some of your approaches. So the question reads, with reference to the information provided and your own knowledge, evaluate the microeconomic and macroeconomic impact of Chile's economy of changes in level of investment. And so we're going to assume that this is going to be an increase in investment. You can write this on a decrease in investment, that would also be fine. But I've just extracted some information from the extracts that I think is going to be useful for writing this. So we see that Chile has credible institutions and just 15% debt to GDP ratio. We see that Chile has large copper reserves in a business-friendly environment, and after 20 years, the remaining ore in Chile is lower grade and requires deeper pits and more fuel to extract. So this is based on the fact that Chile mainly exports copper, and so it's getting more and more expensive to extract that copper. Chile's mining has led to water shortages because they're using water in the production process. There's a long-term steady decline in copper prices from about 9,000 to 5,000 USD per ton over the course of 2011 to 2015. And we're also told that inflation is a little bit high, so we're at 5%, which is just outside the central bank target of 2 to 4%, and the economy has limited spare capacity. Okay, so with these paper 3 questions, I'm almost always dividing it between micro and macro. So my micro impact is going to be improved labor productivity, and I'm going to look at how that affects businesses. And then we're also going to do a macro impact, and in this case, I'm going to focus on investment driving increases in AD. Okay, so for this first argument with the definitions, when I'm talking about labor productivity, I probably am going to define maybe marginal revenue product of labor. I might define variable costs, economies of scale, perhaps, sort of diminishing returns. Depends on the analysis you're writing. I've sort of put the diagram here that I would draw because I couldn't find an image of one. So I've drawn this, and it shows a decrease in average and marginal costs when we get increases in labor productivity. And you can see also shown on the diagram an increase in the profit margin of businesses and also the output along the bottom, the quantity produced. For the application here, I'm going to put in this sort of the bit about us needing more investment to be able to extract the oil and the ore. And also, I might just put in the large copper reserves in a business-friendly environment bit as well into here. And then the analysis is basically going to be as investment, like higher investment is going to lead to increased labor productivity as each worker is able to get more done due to better technology. So the idea is that the higher investment leads to sort of improvements in capital technology and the availability of capital goods, and that's going to increase your labor productivity because each worker has the ability to get more done, say compared to low productivity trying to reach hard to get low quality ore. So that's sort of broadly the argument, and then this is going to lower AC and MC as variable costs go down, right? Because businesses don't have to hire as many people in order to get the same level of output or a higher level of output. So that means that the variable cost of sort of wages go down, This would be fixed cost if you were treating this as salary, so just be conscious of that distinction. Basically, if you're paying someone per hour, that's counted as a variable cost because you're increasing those wages as you're increasing output. But if you're talking about someone who's on an annual salary, that doesn't change depending on output, so that would be considered a fixed cost. So just be wary of that distinction if you're going to talk about them in this way. And then I would also say increased profit margins. And we'd also say increased levels of output, assuming monopolistic competition. So we're kind of assuming this context in the diagram. It might be a little bit different if we're dealing with sort of perfect competition, because probably that looks like not each individual firm increasing their output, but new firms potentially entering the market and prices falling. And then my evaluation might be to say profits might not increase given a steady decline in copper prices, here using that piece of the extract. So this where we say there's been this long-term decline, so I'll plug that in there. Don't be afraid to use some application in your evaluation as well, which might then lead to a steady decline in copper prices would lead to decreasing average revenue and marginal revenue, so lower profits. So this kind of just to show that like there's a pro and a con to this for the businesses. This might not be enough to offset those lower prices. So we might not actually be making more profit. This might just allow the industry to persist, for example. Then in terms of the macro effect, we're going to be looking at how investment drives aggregate demand. So I'm going to definitely define aggregate demand. So consumption plus investment plus net exports plus government spending. So we're looking at investment driving increases in aggregate demand. I might do demand pull inflation. I might talk about long run aggregate supply. And here's the diagram I would use. So we're showing a shift in aggregate demand to the right. The analysis here is basically investment is a component AD, so shifts to the right because I increases. This leads to increased economic growth and higher output in the economy. This should also increase LRAS if we invest money into capital goods, although the effect may take longer, right? Because if we're investing in things like infrastructure, for example, or more storage facilities, stuff like that, which we kind of would expect, new technology, there is going to be benefit for long run aggregate supply, but maybe that takes a little bit of time because some of those investments take time to mature. If you're investing in infrastructure, for example, it's not like new roads are going to pop up immediately. So there's a bit of a time delay on that, but that's good. Together, this should lead to sustainable economic growth. And then I would say for the evaluation, I'd talk probably about the risk of inflation. And I'm going to use my context here again for this bit, the inflation is at 5%. I'm going to put that in because we're already teetering on high. So you'd expect an increase in aggregate demand will increase inflation. So an increase in ADs should create that. I'd also say this is even more likely if AD pushes our level of output beyond long run aggregate supply, and that would be if the investment takes too long or does not focus on capital goods. Right, so this basically I'm saying if we're pushing beyond long run aggregate supply, we would expect then a leftward shift in short run aggregate supply to bring us back down to long run aggregate supplies level, which would drive up prices further. That's because if you're trying to strain your resources, you expect wages to increase faster, you expect the cost of raw materials like the water to increase faster. My judgment then is going to be like, this is likely to increase growth in the economy as increased efficiencies encourage higher output from businesses and a right word shift in AD, perhaps also with shifting LRAS. If LRAS shift should be sustainable. Also, though, I would say, however, it's extremely likely that the economy will experience some inflation. All right, so that would be my judgment at the end. I hope this was helpful. Do let me know if you came up with answers that are different from this. I'd be super curious to hear what you guys come up with.